The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Fairly quiet day in the grain and oilseed trade. At least that's how it felt. We had a little bit of green in corn and soybeans, some more good export demand showing up on the daily wire. Mixed action in the livestock trade with cattle under some pressure, a looming cattle on feed report at the end of the week. Outside markets, some substantial moves lower on Wednesday. Wondering what's going on there. We have elections less than 2 weeks away. A lot going on, kind of swirling around this broader market picture. Let's talk about it. Joining us for analysis, Mike Zuzolo with Global Commodity Analytics. Mike, hope you're having a good week so far. Thanks for being with us.
Great to be back with you, Jesse. Thanks for having me, sir.
I think a spot for us to start is maybe with the elections looming and some of the geopolitical issues that we're watching out there. We have the BRICS going on this week in Russia, et cetera, et cetera. And you know, you and I were talking about this before we went on the air. I mean, the outside market's kind of falling apart in Wednesday afternoon trade. I'm just curious, your thoughts there. Is some of that tied into election jitters potentially, or is it something else, Mike?
No, I think very much so. I think what I'm seeing right now, Jesse, is, and the word of the week is cross currents in terms of assets, in terms of buying and selling. And I don't think you can help but notice that there's some big movers and shakers going on, and another new record high in gold prices, for instance, another 3-month high in the US dollar index. That doesn't usually happen together, or a big surge in US bond yields, creating real interest rates to go up sharply again, and then fresh record highs in the stock market. Again, that doesn't happen very often, and it doesn't make sense a lot of times fundamentally. And so when you have these kind of things happening, this kind of cross current price action, and then when I look over at the volatility index, the VIX, we're starting to get ready to bust through that 20% level, which is kind of the go no-go gauge for the markets getting nervous above 20% VIX volatility. And we're right on the doorstep knocking on that door. I think this is an indicative of the extremes that you're kind of referencing. And I do think it has a lot to do with the election. And I think we can kind of pinpoint it with this chart I created with the help of Real Clear Politics. And I want to stay as apolitical as I possibly can in my analysis. And what I do is I use the Real Clear Politics because they blend together dozens of different polls and come up with an average. And I think they're the most credible source out there for the elections in terms of what's happening. And I also think the market looks at them as well. And so what we have in the last 6 months, and that's essentially what this chart shows you, is President Trump in red, President Biden before July 21st in blue, and then Vice President Harris in blue after July 21st. And you notice that Trump lost his lead after the nomination of Vice President Harris. But now, in the last week, you see the red line getting very sharp in terms of incline ever since we've gotten to the end of September, 1st of October. I think this is what is creating this heavier cross current that is starting to step into the commodity markets, especially through the strong dollar trade. And what I embedded on top of that chart there for the poll was a Financial Times headline saying the strong U.S. economy and the quote Trump trade are driving the dollar rally. And I think this helps answer a lot of questions as far as why are prices and certain assets moving the way they are. It's essentially, you can take a look at it and say essentially for the bonds and for the gold especially, and to a lesser degree the dollar, this is a safe haven trade ahead of the election with the idea that maybe President Trump can pull out another win.
I want to throw this thought to you since we're on this topic here, and I just wonder if maybe some of the political angst ahead of the election, and some of that may be driven some of our good export business here as of late. Just I know that all the talk of tariffs, especially with former President Trump, but even maybe some tariffs or things like that continuing if it was a Harris administration, et cetera. So I just wonder if some of this political unrest or angst, I should say is a better word in this case, is that maybe driving some of our export business right now.
Yeah, we didn't talk about this before the show, but that was number two on my list. That we have to be a little bit concerned that the biggest buyers that are coming in with almost daily sales now of corn and soybeans is Mexico and China. Mexico for corn, China for soybeans. I do think they're stockpiling right now because they are nervous about a Trump victory. And I think that really has to be watched very carefully. It may mean nothing if the weather, the global drought, and the weather stays on the side of cutting supplies, because those major importers are not going to have as many places to go as far as competition that deals with the United States. But if you see the US dollar going higher and you see two of our biggest buyers in grains come in and stockpile, you got to be a little nervous at this point if you're in my line of work. And I think that's a real possibility, if not probability, especially in terms of Mexico and corn buying. And I think that would make sense even more so, knowing that shortly after inauguration, we're going to have to deal with that potential rail strike again. And that could really mess up the supply chain again into the cattle feedlots and into Mexico.
Good thoughts. Another thing that I want to talk about with you on the other side of the world this week is the BRICS meeting in Russia, Brazil, Russia, Iran, China, South Africa. We've talked about this before, Mike, kind of the new East, new West mindset, so to speak. I mean, you look at this summit going on this week, is that having an effect in some of our market trade?
I think it is. And I think this is where the news late last week, after you and I talked midweek about Russia not only starting their own grain exchange, but more importantly, working only with sovereign nations as far as wheat tenders, as the world's largest wheat exporter. I noticed very quickly when that news broke that it made a lot more sense why some of the multinational publicly traded grain companies were seeing massive hits to their stock prices, because there's 13 countries out there that take the lion's share of the world wheat imports that Russia is trying to, it seems to me, lock up and take advantage of in terms of just working with them bilaterally and kind of avoiding and bypassing the international tender system, Jesse. This is a first in history, and that's why I always like to watch the BRICS. And as you say very rightly, this new East, new West political trading bloc dynamics setting up. And even when it comes to military and geostrategic, geopolitical bloc setting up, it is for real, in my opinion. And again, we see, like we oftentimes do, agriculture and especially wheat is at the front lines, the tip of the spear, the one that's going to take the heat the hardest and be the most sensitive to features like this. And it's been that way all throughout history. So this chart right here is a good kind of stepping back type chart with all this noise and all these cross currents going on, and saying, okay, what really drives commodities in terms of commodity index buying of agriculture, whether it's the Goldman Sachs index or any other index that I look at. And it really does have a lot to do with the emerging markets and those BRICS. And you see, like in 2015, 2016, the major lows between this BRIC index, that's an exchange traded fund, in the Goldman Sachs agriculture index. Or if you look at 2020 with what happened with the pandemic, same situation. Both of those made major lows almost identically, one leading the other just a little bit, maybe each time. But essentially, if you want a trend shift in the agriculture complex, you need a weaker dollar, stronger emerging markets, and wheat leading, if not supporting, leading the show. And I think that's where I'm going to stand all the way through the election and even through inauguration at this stage of the game. Until I get that, I'm going to continue to talk to clients about protecting prices. If we, like, for instance, made a new 2-week high like we did today in the corn market, I think it's, keep your eyes peeled now. We're actually making new 2-week highs, not 2-week lows in corn. And when you're in the combine for 4.5, 6.5 weeks without any breaks, you kind of lose a sense of time and what the price action is doing.
Absolutely. Yeah, you kind of get busy with harvest and you don't necessarily know you're not paying that much attention sometimes to what the day-to-day moves are in the grain markets, no doubt. We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Let's take a little bit of a closer look at the corn market. And you mentioned a new 2-week high Wednesday. I know Tuesday we closed right at the 20-day, got above it on Wednesday. Even on a quiet session, felt like that we got some good, robust support underneath the core market right now. Talk about what you're seeing. Let's take a look at the weekly continuation charts. I mean, how do you feel right now about this core market, Mike?
Well, long term, I'm still the most friendly for the corn, supply and demand fundamental wise, Jesse, because of the lack of competition. And I will say that while the South American weather has improved in a very key, timely manner to keep an average crop, if not above average crop, being grown, it is not over with yet. There are still a lot of dry spots, but there's even more dry spots in Australia when it comes to the wheat and barley crop over there. Even more dry spots and more severe in terms of drought intensity, likely increasing the next week or two as we get into the end of October here in the hard red wheat belt, and also especially in the Black Sea region. And I think it's worth pointing out this channel, this downtrending channel, which I really like in the corn because it's right up against one of my favorite moving averages. And you see that 430 area is really a key area of resistance. And if you can break a channel that's been in place since the first quarter of 2022, it should be a head turner. You should be saying, hey, something's different here. And I think what I'm putting together here for like I normally do for all you that are listening and watching, and as I do for my clients, is I'd really like to see that 73% harvest hard red wheat planting progress number falling behind the lowest trade guess on Monday afternoon start to become more of an issue, especially given that prevent planting in the state of Kansas is very quickly upon us around the end of the month, around the end of October. So if I'm going to break out of this channel that's been downtrending in corn since the first of 2022, I really want wheat to be doing it for me, because then the feed grain side of the equation doesn't have to be worried about as much as far as wheat becoming a feed grain versus the corn. And they both have very tight world stocks, as we've talked about. So it would make sense to me if we're going to break through this once and for all, it's going to be with the help of wheat.
Let's flip over to soybeans. Look at that weekly chart. Soybeans were the leader on Wednesday. And November beans getting back close to that $10 handle, which I'd have to think is going to be some psychological resistance here, Mike. I mean, what are you seeing in soybeans right now?
Yeah, this chart looks a little bit different because it's got a little bit more of a steep downgrade to it. And notice that we've got a weekly low right now that was about a quarter of a penny from last week's weekly low. And I think that helped bring in some short covering, especially with that export demand that you noted earlier in the show, Jesse. But unlike the corn, we still have not been able to take out last week's highs in the soybeans. I think that's right around the 1008, 1008 and a quarter, somewhere around there level. We really need to take that out to be able to keep this bean market rallying, in my opinion, especially with South America starting to get back on track on their planning progress based upon some of the latest numbers I've seen, especially in center West Brazil. So beans, I think chart-wise and fundamentally, probably still the leader to the downside, but not as much so now that we've crossed over the 80% harvested level in the United States. And I continued to hear as many producers were wrapping up harvest, they just didn't see what they wanted to see in their bean yield in several states. And I'm also starting to hear that in corn, and especially Nebraska and Illinois, that some of that later planted corn is indeed probably going to get clipped from some of the later planting, and then that drier weather in August taking the moisture levels down in corn, similar to what it did in beans. I talked to a producer this week, and he was shelling 11, 12% corn at this point in time, begging for a rain, essentially.
Let's go over to livestock trade. I want to touch on cattle first. Let's start with feeders. We saw some pressure there Wednesday. And we got a cattle on feed report coming up at the end of the week. I know we're going to talk about that here in a minute as well, but I'm starting to like the term bearishly optimistic in cattle, if that's a way to go here. I'm stealing that from a conversation I had a few days ago. I mean, what are you watching right now across this cattle complex, Mike?
Yeah, and I would probably word it this way: I'm a skeptical bull in the cattle. I think I think that you can't ignore the choice box beef prices, and they're not backing off. And the packer margins are good, and you've got that choice select spread now breaking through $29 premium to the choice. I think that's going to be a new 2024 record for the week if we stay that elevated through Friday. The choice boxes are only about $6 from the 2024 high on a monthly closing basis. And so you really do have to applaud the strength of the box beef and therefore the fat cattle market. And I think a lot of that does go back to the hog market standing up for it and the competing meats not being able to take much market share. Having said all that, Jesse, we've got a managed money fund market that's at a new 2024 net long high. And a lot of that, I think, is built upon in my opinion, the house of sand of the stock market rally, because it's very odd historically, if you're not stimulating the economy through the government, to see bond yields go up and the stock market rally, let alone make new record highs. It's very odd to see gold make new record highs with the stock market making new record highs. Because of inflation, because of interest rates, it doesn't make a lot of sense unless you're talking about the idea that the President Trump need in terms of building in a premium is creating the idea that he's going to spend by cutting taxes, and that's going to be very good for Wall Street, but it's also going to sour the bond buyer, and therefore they're going to need a higher yield to go after U.S. Treasuries. And that's why that dollar is rallying with the bonds going down and the yields going up. So it kind of all fits together nicely with this idea that the former president is starting to win in the market's eyes the election. So I'm very, very nervous ahead of Friday's cattle and feed report that this stock market pullback that we're seeing right now, testing some very crucial support levels, and this wedge that we see in the weekly feeder continuation chart, I feel like something's going to give relatively soon. So be on point that if the corn's going higher and the stock market's going lower, why wouldn't you want to hedge the fourth quarter feeder cattle?
Absolutely. Absolutely. And that wedge is very well defined on that weekly feeder chart. And you mentioned cattle on feed report. And, that is something that I feel this way. If we were to get some sort of massive surprise on feed report, it may not be the fundamental reason why it could move cattle lower, but it would be the excuse. I guess that's the way I would put it, Mike. What do you think?
Yeah, I mean, we're at a point now where the trade is expecting at some point a lower number, but they're not expecting the herd to really go down, the placements, I should say, to really go down that much. In fact, the placements number is coming out at about 96%, with the high of 99. And I'm at 94.5 on placements. That would be quite a bit less than last year, given that we did about 2.2 million head for September placements last year. So I'm closer to 2.1, 2.085. The trade's at 2.1. And if we can get that, then that on feed number, that green star you see on this chart of 11.5 million on feed, would take us below the average trade guess of 11.545. And I think that would get the trade to start to wake up to the idea that maybe we've worked through most of the cattle that we're going to put into lots, and retention maybe is right around the corner. And I think it's coming. I'm not sure it's going to show up in this report, but I feel like it maybe will show up, if not this month, next month, because I'm starting to get the feel that the feeder cattle market has had its day. It seems like we're just tightening up a little bit and maybe getting ready to retain a little bit more. So the key for this chart, though, for me and the price action and what we were talking about a minute ago, is to stay at or below 11.5 million head on feed, as of October 1. I think that can keep the market well balanced and not too much supply.
You mentioned hogs earlier too. I should ask, front month hogs getting above the $80 handle on Wednesday's close. Man, just feels like there's some good fundamental support under that hog market, Mike.
Yeah, bellies have come in on a counter seasonal move and really helped support the overall cutout, keeping us near that $90, $100 level. The key, I think, now is to get the ham seasonal kicking in here as we get ramped up for Thanksgiving. I'm hoping we see buy a turkey, get a free ham again this year, and that keeps that hog market supported, because I am nervous, Jesse, that China's not doing enough for their economy. And if they're not, it could really show up in some of the hog futures and how the managed money position themselves in the first quarter of 2025. So if we go up another leg in the hogs, I think they too are very much worth taking a look at on the hedge side.
Who doesn't love a good 2-for-1 turkey ham special, right,
I'm
Mike?
there. I'm there.
Well, now that I'm hungry, thank you very much. Let's close it out today. Excellent stuff. A lot going on in these markets right now. And I know if folks have questions, they want to look at your analysis and more, going onto your website is a great way to get started, isn't it, Mike?
Yeah, and I just did a 6-page report on what we just talked about. So to kind of line things out, Jesse, in a real formal manner to kind of keep track of it, because as somebody that does independent analysis, I've got to keep track of where I'm at on the analysis side, especially in these times. So globalcomresearch.com is the place to go.
Globalcom with 2 M's research.com. Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks so much. We'll talk to you next week.
It's been a pleasure, Jesse. Thank you.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.